Hi everyone. In this video, I will explain to you key fundamental ratios necessary to assess the profitability of any company and also understand the true value that that company can generate over the years.
In this video, I explain ROIC, ROCE, ROE, and ROA, starting from the most important ratio for value investors. I also show how each one is calculated, what financial statement items are used, and what high or low values actually mean. ROIC means return on invested capital. This is the most important profitability ratio for value investors because it shows how efficiently a company converts long-term capital into operating profit. A company creates value only when ROIC is higher than its weighted average cost of capital, also known as WACC. To calculate ROIC, we use NOPAT, net operating profit after tax, from the income statement and divide it by invested capital from the balance sheet. Invested capital means all the long-term capital actually used in running the business. It includes shareholders' equity, long-term debt, lease liabilities, and other operating liabilities. It excludes non-operating items like excess cash or investments that are not required for the core business. A high ROIC usually signals strong competitive advantages, pricing power, and long-term value creation. A low ROIC means capital is not being used efficiently and returns are weak. ROCE means return on capital employed. It measures how efficiently a company generates operating profit from long-term capital, and it is especially useful for manufacturing and industrial businesses. To calculate ROCE, we use EBIT, earnings before interest and tax, from the income statement and divide it by capital employed, which is total assets minus current liabilities. A high ROCE indicates strong operational performance. A low ROCE suggests inefficient capital use or a heavy capital structure. ROE means return on equity. It shows how much profit the company generates for shareholders using shareholders' money. ROE is most relevant for banks and financial institutions. To calculate ROE, we divide net income from the income statement by shareholders' equity from the balance sheet. A high ROE is generally positive, but if the company is heavily leveraged, the ROE may appear high even though the underlying performance is weak. A low ROE suggests weak profitability or dilution. ROA means return on assets. ROA, it measures how efficiently a company uses all of its assets to produce profit. To calculate ROA, we divide net income from the income statement by total assets from the balance sheet. A high ROA means strong asset efficiency, which is typical for asset-light companies. A low ROA is normal for asset-heavy industries such as utilities, airlines, telecom, and transport. In simple terms, ROIC tells you value generation quality. ROCE tells you efficiency of capital. ROE tells you rate of returns. And ROA tells you asset use efficiency. Together, they reveal the real strength of any business.
I hope you found that educational and stay tuned for similar videos of fundamental ratios and fundamental analysis, which will prepare you to become a successful international investor. If you like this video, please subscribe and do stay tuned on.